Welcome to the deep dive. This is where we really try to cut through all that market noise. We take a whole stack of information and boil it down to the most important nuggets for you. Today, our mission really is to untack the June 2025 market compass. That's from Thursday, June 26th. We're going to dive right into the forces shaping today's financial landscape. Our goal, extract those crucial insights, those sometimes surprising facts, to help you get, truly well informed on the market's pulse.
That's exactly right. And what's always fascinating, I find, about looking at market movements is just how dynamic they are, how interconnected. It's almost never about just one isolated data point. Instead, you see these seemingly separate news items often weaving together, and they reveal these much larger, much more crucial trends playing out. So for this deep dive, we've pulled from quite a range of sources, major news outlets, CNBC, the New York Times, Bloomberg, but also key financial reports, government releases. The aim is to connect those dots for you, show not just what happened, but really why it mattered.
Okay, good. Let's kick things off then with a quick look at the overall market sentiment. We're pulling from the market overview section, focusing on the close of trading June 26th. So what did the major indices tell us? What can we sort of infer from how they performed?
Well, it was definitely a mixed bag. It really paints a picture of some underlying complexity, I'd say. The S&P 500, it closed precisely flat, 0.00%, which is interesting because it had been up about 0.30% in pre-market.
Ah, okay.
Or then the Nasdaq, it actually managed a slight gain, closed up 0.31%. That was after an earlier pre-market rise of like 0.39%. And then you had the Dow, it went the other way, dipped 0.25%, and that was a reversal from its own pre-market gain of 0.22%.
So flat S&P, Nasdaq up a bit, Dow down a bit. That's hardly a unified direction, is it? Suggests investors are maybe grappling with different signals, different sectors.
Exactly, it's complex, which is precisely why we need to dig into the details. That's where things get, well, really illuminating.
Absolutely. And we've got a great stock and market news section here. Covers a really wide variety of corporate stuff.
Yeah, definitely. And to make sense of it all, we've sort of grouped the news into a few key themes. Makes it a bit easier to digest. First up, let's talk about something that just keeps dominating headlines. AI. The AI evolution and the huge tech bets being placed.
Right. NVIDIA, NVDA, gained a pretty significant 4% yesterday, hit a record close, $154.31. I mean, that's a huge move for a company that size. What's driving that? Especially with all the talk about, Chinese export restrictions.
Well, the striking thing here is just how clearly investors are betting on that strong, continued AI demand. They're betting it's going to not just offset, but actually overshadow the company's losses from those Chinese export limits. It's a really clear signal from the market. Future tech breakthroughs, especially AI, they're being valued more highly than these present-day geopolitical headwinds. So the takeaway, the market's got this aggressive, forward-looking stance on AI, even if it means overlooking some current friction.
And speaking of AI reaching further, it looks like OpenAI is now developing autonomous driving tech, trying to rival Tesla directly. They're using AI video tools, simulations. Feels like AI stepping into a totally new arena.
Yeah, if you step back and look at the bigger picture, it points to this broader trend, doesn't it? AI's reach is just expanding into totally new competitive arenas. We're seeing AI move beyond, traditional software apps and right into physical world applications, challenging established players like Tesla right on their home turf.
Wow.
It's not just a software update anymore. It's potentially redefining whole competitive landscapes.
And that relentless push for AI, it also means a fierce battle for talent, right? And for promising startups. Like we're seeing this AI search startup, Perplexity. It's drawing serious acquisition interest from giants. Meta, Apple. Meta's offer didn't work out, apparently, and Apple hasn't made a formal offer yet. But the interest is definitely there.
Yeah, and that just highlights this intense scramble, doesn't it, among the tech giants?
Mm-hmm.
They need to acquire or develop cutting-edge AI capabilities. These smaller, innovative startups, they're seen as critical pieces in that puzzle. It's basically an arms race for future dominance. And these acquisition talks, they're just the visible part of that whole strategic game.
Okay, so moving away from AI for a moment, our second big theme seems to be corporate strategy and restructuring. Looks like a lot of companies are making some tough choices trying to adapt. Take Bumble, the dating app. BMBL, slashing 240 jobs. That's 30% of their workforce. Aiming to save $40 million a year. This is happening while their revenue and user growth are declining. But here's the kicker. Shares surged 17% on the news. How? How does that happen? Seems like bad news.
It does seem counterintuitive, right? But it signals a really major shift, I think. In today's environment, the market is prioritizing efficiency. a clear path to profitability, much more heavily than just pure top-line user growth.
Which used to be everything in tech.
Exactly. User growth was king. Now, this focus on financial discipline, even really aggressive cost-cutting, is becoming a key driver for investor confidence. Especially, with capital getting more expensive. The market's basically saying, show us the money, not just the user numbers anymore.
So proving a sustainable, profitable future is now more important than just hitting those traditional growth metrics.
Precisely. And we actually see echoes of this strategy in other sectors too. It's not just tech.
Like Kroger, the retail giant, KR. They're optimizing their footprint too, closing 60 U.S. stores over 18 months to boost profitability. But, at the same time, opening at least 30 new stores in high-growth areas. What's that tell us?
It demonstrates that strategic shift, doesn't it? Optimizing the physical footprint. They're clearly focusing on efficiency, targeting areas with higher growth potential, basically acknowledging that not all retail locations are equal in today's market. It's about being leaner and more strategically located. Smarter.
Okay, and even my morning coffee isn't safe. Starbucks SBUX, introducing a flat 80-cent fee for all drink syrup and sauce modifications, feels like a direct hit. But seriously, what's the strategic play here? For a brand so focused on customer experience, is it just the bottom line or is there more to it?
Well, it's a fascinating little case study, actually, how even small pricing tweaks by a huge consumer brand can reflect these broader strategies. Profitability, sure, but also customer experience. It's likely about simplifying pricing, maybe managing the complexity of all those custom orders, possibly nudging customers towards less resource-intensive choices. All while, yes, aiming to capture a bit more revenue from those highly customized drinks. It's subtle, but it's a significant change for their loyal base.
And then there's Southwest Airlines, LUV, known for its no-frills model, right?
Okay.
Budget-friendly. Now they're exploring lounges, first-class seating, even long-haul flights. Trying to attract higher-spending customers because fare pressure is mounting, that feels like a massive strategic pivot for them.
Oh, it absolutely is. The wider implication here is a really significant strategic pivot. For an airline that built its identity on that unique, low-cost model, it indicates just how much competitive pressure there is in the travel sector right now. It's pushing even established players like Southwest to consider totally new revenue streams, new customer segments they previously, avoided. Shows how intense the competition is to grab every possible travel dollar.
We also have BlackRock, BLK, making a pretty major move in the investment world. They're launching a 401k target date fund in 2026, and it'll allocate 5 to 20% to private equity and credit. That sounds like a pretty big deal for the average investor.
It's really remarkable, actually. What's fascinating here is the potential democratization of access to these previously exclusive private market investments, right in the average retail investor's retirement savings. Historically, these kinds of assets, they were only really available to big institutions or, the ultra-wealthy.
Yeah.
But it also brings up important questions, doesn't it, about risk, liquidity, especially for retirement savings. Because private markets can be less liquid, more complex than your standard public stocks and bonds. It's a bold move, opens new doors for sure, but introduces new things for everyday savers to think about.
All right, let's shift gears a bit. Third theme, political currents and market speculation. Because, let's be honest, politics always seems to find its way into the markets, doesn't it? Trump Media, ticker DJT, pivoting to crypto, and planning a $400 million stock buyback to boost valuation. This is while their shares are down, 56% since President Trump's inauguration.
Yeah, this really highlights how companies tied closely to political figures can see their stock performance influenced by non-traditional market factors. They often move based on sentiment or political news almost as much as traditional financials. And using bold strategies like big buybacks and these crypto pivots, it's a clear attempt to stabilize the valuation, right? Create new narratives to attract investors, given that significant stock decline.
And sticking with politics, but moving to the space race. Amid President Trump's reported split with Elon Musk, we see Jeff Bezos and Blue Origin lobbying harder for U.S. space contracts. Blue Origin, of course, currently trails SpaceX in launches and contracts.
If we connect this to the bigger picture, it just clearly shows that interplay. Political relationships, competitive dynamics, all happening within this rapidly growing private space industry. Federal contracts are a huge piece of the pie there. So lobbying efforts, they become absolutely critical when government money is involved, especially as these rivalries heat up.
And finally, just a quick one on market rumors. Shell had to come out and publicly deny reports claiming the oil giant was in takeover talks with BP. Shell says no such discussions have happened.
Right. And this just demonstrates how quickly market rumors can spread, can't they? And really gain traction, especially in a sector like energy, which can be highly liquid, highly speculative. It underscores how major corporations have to publicly address speculation, manage investor confidence, prevent wild swings in their stock, especially when it involves potential mega mergers between industry giants.
Okay, our fourth and final theme for corporate news focuses on industry disruptions and some really unexpected outcomes. Seems like no industry is safe from intense competition these days. Monster and CareerBuilder remember them, both owned by Apollo. They filed for Chapter 11 bankruptcy, selling core assets, citing a weak job market, sure, but also rising competition from LinkedIn and Indeed.
This really brings to light the challenge, doesn't it? Even for established players.
Yeah.
Adapting to fierce competition, adapting to these dramatic shifts in industry landscapes. It just underscores the sheer power of digital disruption. In this case, LinkedIn's professional network combined with Indeed's massive job listings, they simply outmaneuvered these once dominant forces in online recruitment, pushed them out, essentially.
And talk about unexpected outcomes. Altimmune, ALT, a pharma company, reported its new obesity drug met its main mid-stage trial goals for treating fatty liver disease. Sounds like great news, right? Yet the shares fell a staggering 56% pre-market anyway. What on earth causes that kind of reaction to positive news?
It is truly counterintuitive, isn't it?
Yeah.
Wild. But this often points to the market having already priced in an even more ambitious outcome. Maybe they were expecting breakthrough efficacy like way beyond what the trials actually showed. Or maybe overlooking the intensely competitive landscape in obesity drugs. It's already crowded, right? Big players like Eli Lilly, Novo Nordisk. It's just a harsh reminder that good news isn't always good enough for Wall Street expectations. Sometimes they expect phenomenal.
So it's not just about meeting the clinical goal, it's about beating the market's whisper number or the perceived potential against competitors.
Precisely. And it forces companies to manage those expectations incredibly carefully because, well, the market can be pretty brutal in its assessments.
Okay, let's shift gears again. Let's zoom out now to the wider economic environment, the backdrop that shapes all these market movements we've been discussing. Because without understanding that context, it's hard to fully grasp the corporate plays, I think.
Exactly right. Let's start with the U.S. dollar. Hit a 3-year low today. It's down a significant 10% year-to-date, getting close to the largest first-half decline since, wow, the early 1970s. So beyond the obvious trade impact, what are the ripple effects? For specific sectors, or even for average consumers, that might not be immediately apparent.
Yeah, a 10% drop year-to-date is definitely significant. What does a weaker dollar mean for, say, the average person listening?
Well, a weaker dollar has pretty significant implications right across the board. Sure, it can make U.S. exports cheaper, more competitive globally, but it generally makes imports more expensive. So for you listening, that could mean higher prices. Things like imported electronics, foreign cars. It also impacts multinational corporations, actually. Their earnings generated overseas, when they convert them back to a weaker dollar, they're worth more on paper. So pros and cons.
And the housing market, it just continues to be tricky, doesn't it? New home sales fell, surprisingly, 13.7% in May. MISC forecasts hit a 3-year supply high, yet prices still climbed 3% year over year. Median price, $426,600. What's behind that disconnect? Falling sales, but rising prices.
This really highlights the complexity, doesn't it?
Yep.
Housing market demand, affordability. The core issue fundamentally remains a supply-demand imbalance. Even with sales slowing down, there just isn't enough affordable housing out there to meet the existing demand, especially at those lower price points. So that keeps prices elevated. Even with rising interest rates, even with buyers maybe getting hesitant, it points to a really challenging environment for both buyers and sellers.
Okay, but on a brighter note, maybe, for consumers, gas prices hit a 4-year summer low. U.S. gas prices averaging $3.20 a gallon right now, lowest for late June since 2021. And this is attributed to the Israel-Iran ceasefire stabilizing oil markets.
Yeah, what's remarkable here is that direct impact. Global geopolitical events hitting everyday consumer costs. It just illustrates how interconnected our world really is.
Sure.
A significant de-escalation in tensions thousands of miles away can directly translate into tangible savings for you at your local pump. It's a powerful reminder, isn't it? Global stability benefits everyone's wallet.
And just a quick pulse check on the labor market. Seasonally adjusted initial jobless claims totaled 236,000 for the week ending June 21st. That's down 10,000 from the week before. The 4-week moving average was 245,000, down about 750 week over week.
Yeah, this gives us that quick snapshot of the labor market's health. Shows a slight positive trend anyway in new unemployment claims. It suggests some underlying stability, maybe even a slight improvement in the employment picture as fewer people are filing for those unemployment benefits.
Good. Now, before we move on, it's worth noting, later today we've got several key economic data releases scheduled. Always potential market movers. Durable goods orders, GDP growth rate, the Chicago Fed National Activity Index, corporate profits, pending home sales. And then tomorrow, we get the big one for inflation watchers, core PCE price index. Plus, personal income and spending. Always good to keep an eye on those. They can definitely shift market sentiment pretty quickly. Okay, let's unpack this even further. We've seen some pre-market reactions, talked about the news, but now let's dive into the full recent earnings reported today. This is where companies really show their financial scorecards, right? Prove their mettle.
Indeed. Let's start with Micron Technology, MU. They reported just outstanding numbers. Revenue jumped over 36% year over year, beat estimates by $450 million, significant beat. And their EPS soared over 200% year over year, comfortably beat expectations by 30 cents. Wow. Those are truly incredible numbers, especially that EPS growth.
And these strong figures, the revenue, the EPS growth, they directly validate that earlier point we made, don't they? About the booming AI-driven demand for their chips, their high bandwidth memory. It shows the tangible financial impact of this AI revolution on the companies supplying the foundational tech.
Okay, then we have McCormick and Company, MKC, Spices and Flavors. Their revenue came in just slightly below estimates, a tiny miss, only $1 million. But their EPS was 69 cents, beating estimates by 4 cents.
Right. So while revenue had that minor miss, the EPS beat, and that pre-market rise we saw earlier, it suggests the market appreciated their profitability and appreciated that they reaffirmed their 2025 guidance, even though they're facing tariff pressures. It just underscores, I think, that for established companies, sometimes that clear path to profit can be more impactful than hitting every single top-line revenue target.
Makes sense. Okay, quickly running through the others. Jefferies Financial Group, JEF. Revenue beat expectations, but EPS saw a big year-over-year drop and missed estimates. Walgreens Boots Alliance, WBA, strong revenue, beat estimates comfortably. EPS also came in ahead, despite a year-over-year decline. Acuity, AYI, posted revenue that beat by a healthy margin. An impressive EPS that also significantly outperformed. And finally, HB Fuller Company, FUL, slight revenue miss, but their EPS beat estimates.
So yeah, as you can see, kind of a mixed bag of earnings results across the board. Some companies like Micron clearly riding strong tailwinds from big industry trends like AI. Others, maybe like McCormick or Walgreens, they're navigating challenges but showing they can find paths to profitability, meet guidance, even if revenue faces headwinds or has minor misses. It's all about, effectively navigating the current economic climate.
Right. Okay, before we wrap things up today, let's take a quick look at the new kids on the block. The company's confirmed for IPO today.
Yeah, we have 3 new listings. Kind of highlights the diversity entering the public market. First, Canter Equity Partners III, Inc., ticker CAEP. This is a blank check company, right? A SPAC.
Okay.
Essentially a shell company that went public just to raise money specifically to acquire an existing private company.
Yeah.
In this case, they're targeting digital assets, real estate, fintech, software.
Okay.
Then there's Jefferson Capital, Inc., Jay Seckley, this is a consumer collections firm. Pretty substantial trailing 12-month revenue, solid year-over-year growth reported. And finally, Geelong Holding Limited, JLHL. That's a Chinese engineering services provider, also showing strong year-over-year revenue growth.
So a truly diverse set then. New companies coming to the public market, blank checks looking for future deals, established service providers, both domestic and international. Just shows that continuous evolution of the market, doesn't it? And the variety of businesses looking for public capital. So after all that, what does this all mean for you? As we've navigated through the June 2025 market compass today, a few major themes really stood out, I think. There's that undeniable, just pervasive influence of AI across so many sectors. Driving innovation, yes, but also really fierce competition. We also saw those strategic shifts companies are making, from aggressive cost-cutting like Bumble to exploring entirely new business models like Southwest, all trying to adapt, trying to thrive in this dynamic landscape. And underpinning it all, right, that ongoing interplay of broader economic factors, geopolitical factors on market performance, affecting everything from, well, your gas prices to long-term investment opportunities.
Yeah, and to reiterate, the real value in understanding these nuanced movements, it's precisely that market news isn't just about isolated numbers or catchy headlines. It's about connecting the dots, seeing the bigger economic stories, the bigger corporate stories playing out. And having that comprehensive view, it allows you to anticipate, maybe rather than just react, to see beyond just the surface level news.
Exactly. So we encourage you, listening, to observe how these trends might unfold in the coming weeks, the coming months, and beyond. Because understanding these intricate details, these underlying currents, It truly empowers you in your own financial literacy. It helps you see beyond those headlines and grasp the why behind the what. And, as we've seen companies like Bumble make these drastic cuts that actually send their stocks soaring, and Kroger strategically optimizing its store footprint.
Yeah.
And even an obesity drug with positive trials seeing its stock absolutely tumble, it really raises an important question for you to consider. In today's market, where seemingly good news can lead to a stock dip and tough choices can lead to a surge, how has the very definition of market success fundamentally shifted? Something to think about.